Hi, everyone. Welcome to another Learn, Grow, Invest meeting. I'm Jermaine, founder of Learn, Grow, Invest. Today, we have a really good session for you. I'm just going to jump right into it. So let us pray. Lord, we thank you for this day. We pray, Lord, that you'll bless this time, bless this session. I pray that it'll be a meaningful session for everyone involved. In Jesus' name, amen. Right, so today we're going to talk about how to pick great stocks. And it's something that I think every investor would want to know. I've tailored this session to be a beginner's session. So don't worry if it's your first time, you don't really, understand investing. I'm going to use simple terms, right? So I've tailored the session so that if you're brand new to investing, you can follow along. But when we get to a certain point, you should be able to build on these concepts that we'll go through this session for the other parts of this series. So this is meant to be a 4-part, maybe 5-part series. We're going to go through the process of selecting stocks to invest in. So I have to say, though, here at L.E.A.R.N. Grow Invest, we are not financial advisors. We may feature advisors from time to time, but there is no member or part of the team that is here to give financial advice. We're here to educate. We're here to inform. We're here to present options, and you make your own decisions with the help of a licensed financial advisor. So as I go through, though, let me know if you have any questions in the comments or in the chat, and I will try to get back to them as soon as I can. All right. So as I was saying before, this is meant to be a 4-part series. So we're going to start today with what's called fundamental analysis. Now that covers 2 key aspects, and then I'm going to include some other steps that I go through to select stocks to invest in. So the very first thing that we want to talk about is why or what is fundamental analysis, and it's essentially using the financial statements, which we look at today, economic information, so that's news reports, information about GDP and interest rates, all of that information that relates to the industry you're invested in, as well as the country and the markets that could be impacted. And then on the last session, I believe week 4, we'll be talking about how to forecast earnings that are not yet released based on what we call, well, we're going to go through that process. I don't want to give anything away as yet, but we use this process to identify what really drives the business, essentially. So you want to really keep a track of this information for the companies that you are invested in. I narrow my field of view usually to the companies that I'm holding. I don't really follow or track information for the companies that I'm not interested in or I'm not holding myself, and that will help you as an investor to kind of filter the noise, as we would say. So this can be tedious if you're doing it for 30, 40 companies, but if you're only doing it for 15, 10 companies, then it is actually a manageable process. So we'll walk you through that. So fundamental analysis is really the study of a couple of things, right? We're starting with the financial statements, which, as I said, we'll go through today. It's reviewing the economic information, as I said. So what's the interest rates? What are prices like? What's the impact of inflation? And those are some of the things that we discuss in the L.E.A.R.N. Grow Invest group daily, because all these things impact the success of our investing. And further to that, we want to understand, so a very great example of this. So right now we're talking about, the supply of vaccines. How is that going? How is the fact that I think only 1% of the country is vaccinated so far, and we just announced that we're going to be opening up our kind of relaxing some of the measures. What would that impact have on the economic environment? So while it may be good for businesses, what other impact may there be? Those are some of the things you look at. as a part of fundamental analysis. The next thing that you want to look at and zero in on is the industry of the company itself. So we're going to look at a company that's a part of the manufacturing sector today. So what does that mean? What are the other companies within that industry? And when we start to analyze the companies, we'll be using the industry as a benchmark to say whether or not the company is doing well or not. So there are two key aspects that you want to think about when we talk about fundamental analysis. There's the quantitative, which we're going to lead with today, and the qualitative. So the qualitative, has to do with things like, market share of the company, management of the company, what's the brand like, does it have a good reputation? And, those things actually play a role in what persons are willing to pay for the investment. So if you think about it, there are some companies that do really well and, maybe even better than you'd expect because they have a solid brand, because they have good sentiment in the market. And there are some that they do really well financially, but don't do as great because people don't really care about them. So that has an impact as well on the stock price, which means it could impact, whether or not it would meet your investment goals. So as I said before, this is a 4-part series. We're gonna cover, in part 1, we're gonna talk about the following. We're gonna talk about the quantitative analysis of a stock. So we're gonna look at one today. I'm gonna show you how to access the report, how to go through the financial statements and what they mean at a very, very high level. And then, I mentioned that before, we're going to do a quick analysis. So this is nothing technical, not super. It's not going to be above anybody's heads, but I'm just going to talk about it as I would if I own the company. If you own the company, we're going to look at the balance sheet, the income statement, the cash flow statement, and analyze it as if we were running the companies that we're looking at the statements for, and what type of decisions we would make, what things we would look at, how we would manage cash, things like that. And the last thing that we're going to do, which I think will be very helpful, is we're going to look at an equity analyst report from NCB for the same company whose statements that we'll be looking at. So hopefully at the end of that, you'll be able to see how you can use your own analysis with what a brokerage firm would do and see whether or not you're on the right track. All right. And while I'm talking, just let me know if you have any questions in the comments. I'm seeing all the greetings. Welcome everyone. Thanks for being here. If you have a question, just post it and I'll get to it on the break. All right. So everything that we're going to be talking about today in terms of the core focus of the meeting is the quantitative aspect. So it's all about the numbers, but you don't have to be a math person. There are simple calculations that I'll show you, simple formulas that you can work with, and you'll have an understanding of how well the company is doing. So when we talk about the quantitative side, it's all about what we can measure. If it can't be measured, then it's considered qualitative. And we're going to talk about the qualitative, which is extremely important as well, but we're going to cover that in a subsequent meeting. So everything that we're going to talk about today is based on the financial statements. So we're going to talk about 3 statements. So the balance sheet, income statement, and cash flow statement. So let me know in the chat anyone who has never looked at one of these statements before. If you've never, ever looked at a balance sheet, never looked at an income statement, never looked at a cash flow statement, let me know. And then you can say after today that you know what it looks like and you know how to read it. So we're going to start with the balance sheet, right? So the balance sheet, as the name implies, shows really the assets, liabilities, and equity at a particular date of time for that company. So for those of you who run your own companies, you understand that assets are anything that you own. They are supposed to generate money or be worth something. Liabilities are like debt, are like things that you owe, so like payables. So if you think about a personal balance sheet, a liability, would be a loan. A liability would be your utility bill that needs to be paid, or it would be a mortgage. Things like that are considered liabilities. It's the same way for companies. They have liabilities that they have to pay. Some are long-term, some are short-term. And then we have equity. The equity really represents, if you think about, again, a personal example, if you have a mortgage and you started to pay off the mortgage and now there's a gap between the start of the mortgage and the balance you now have, that is considered equity. It's pretty much the same thing. So the assets minus the liabilities would give you the owner's equity. And that is really saying, okay, after we've paid off all the liabilities, that value that remains is for the shareholders. And we'll look at that later on. So in terms of the balance sheet, all you need to remember is this very simple formula. Assets is equal to liabilities plus owner's equity. If you rearrange the formula, it will, still balance, right? It will still give you the same amount. And that's why it's such a very powerful equation. And when we look at the balance sheet, you'll see. All right. So the next thing that I want to kind of give you an understanding of is the types of information that you'll see on the balance sheet. So first we have our assets. And as I said, there's anything that relates to anything that the company owns. So for example, cash in the bank, that's an asset. Cash equivalents would be anything that, considered to be, liquid. So it could be a number of things, but typically when it's labeled cash equivalents, it's just as good as cash, meaning can be converted to cash quickly. Accounts receivables would be what is owed to the company. So let's say that I run a small business and, there are persons who owe me for my services. That service, if they have not paid the bill, is considered accounts receivable. That is an asset to me. I may have inventory. So let's say that I create headphones, right? And I need the raw materials to make the headphones. That's inventory. That is an asset because it can be used to generate income. If I would have done any prepayments, so let's say that I decided to pay my entire internet bill for the year, I can list that on my balance sheet to show that I've prepaid that amount. And so it's an asset because I have not yet used the service. So as it relates to my supplier, it is seen as a credit on my account. Next, I have property. So if I have a house, if I have a business place, if I have, I have to own it for it to be listed there. And equipment would be, let's say, the machinery that I use. And next, we have any investment. So if I, as the company owner, have some stocks that I use the profits of the business to invest in, that would be considered an asset to the company. And we see that a lot of companies do this, where they use some of their cash to invest in other things so that they can generate profits or interest from their cash. Liabilities, I think it's pretty straightforward. Any debt, if we have employees that we need to pay salaries for, that's considered a liability. Any dividends payable. So when we receive dividends from a company, it's a liability to them, right? And if we have any taxes to be paid, it's listed there as well. Shareholders' equity, as I mentioned on the previous slide, it would be the balance when we subtract all the liabilities from the assets. And we also have here the retained earnings. So when whatever is left after the company has covered all of its expenses, it's considered retained earnings, and that is actually a part of the shareholders' equity. And the company may decide to keep that as cash. It may decide to pay out a dividend from that or something. So one very important thing to note is that dividends are paid from profits. So you will not likely be able to get dividend from a company, though I have heard stories that companies pay, we won't go there right now. Let me just fast track that one. So we're going to look at an example of a balance sheet right now. So let me close that for 1 sec. And I'm going to share. All right, so I'll ask the moderator to post a link in the chat for the balance sheet example that I'm going to be bringing up right now. So persons can follow along if they wish, all right? So persons who would have guessed on, I'm going to zoom into that. So we're looking at Wisynco's balance sheet as at March 31st. And as I said, a balance sheet is a snapshot. So we could do a balance sheet every day, but it wouldn't make sense. So typically companies do these statements at the end of a quarter or the end of their financial year. It seems a little bit more practical that way, but just know that as things change in the company daily, you can have a balance sheet done. So for example, if you had a tool like QuickBooks, you could generate your balance sheet every day, right? So as we said before, we have assets, and we see here that it's split, non-current and current. And well, before I go any further, let me just explain. When we see these 3 zeros at the top, it means that the numbers that we're seeing here are in the thousands. So this number that we see here, for example, that looks like 20,771, it's really saying 20 million, which means that this number here that says 6 million is really 6 billion. So that gives you an idea as to how much this company has in terms of, property, plant, and equipment. And typically what we'd see in these statements is that it shows you a comparison between the same date or the same snapshot the year before and the current year, so that you can do a comparison, because imagine if you only saw the first column, it really wouldn't make sense to you. The numbers wouldn't make sense. You'd be saying, okay, all right, you have 6 billion in terms of property, plant, and equipment, but what is that in relation to? Is that good or bad? And we can say, well, the previous year, a year ago, there was the value of those assets were, a little bit more. So then if this was, let's say that we look at the next report and there's yet a greater variation of that number, we may want to investigate further and say what would have led to that. So typically when you see these changes in the financial report, they would put a note to say that, assets were sold, or they might have liquidated it based on maybe the age of it. It could vary, but the notes are typically there to tell you or explain anything that would need clarification. So if you look at this item here, investment in associate, and it says note 5, it means within the same document, there'll be a note 5 or an item 5 that we can go to and see an explanation for this item. So, going through this balance sheet, I can typically just have an idea as to how some of the numbers are changing over that period. So, the previous one, loans receivable would have been, 167 million. Now it's a little bit higher. It's 198 million. Then I could maybe want to watch this number to see how it progresses, because receivables, once it's an asset, it's owed to the company. So depending on how high that number gets, depending on the company, you may want to, see how well the company is able to manage their receivables. Some may say receivables are a good thing. It means that they're generating more business, and sometimes you have to allow your customers, credit or anything like that. So, and then you may want to investigate to see what the loan was for, depending on if that information is shared. And I will also say investment securities that would have increased from the previous period, which is a good thing. You want to know that a company is investing their funds. And then we have the current assets. So the difference between the current and non-current, current is anything that can be converted to cash within a year, and non-current would be considered anything that the company either uses to generate revenue, as we said before, or anything that's not easily converted. So it's not likely that the company will be selling their property, plant, and equipment within the first year. That would typically be over a number of years, or for maybe they want to use that money to invest in something else, or maybe they want to upgrade their facilities. It really depends on the company itself. So we see that, at the end of this period, March 31st, Wisynco had 12 billion in assets, right? That's the main number you want to watch. Now we have liabilities. So we spoke about this. So things that are to be paid, money that was borrowed, liabilities that are there, and the taxes that are payable. And we can now look at how those numbers compare to the period before, right? So in essence, you could just look at the number in terms of the total and just say, okay, it would have been 6 billion. I know it's 8 billion. That's one way to look at it. You could also just, it's just for your information. You want to see how the company is managing its overall position. Then we have shareholders' equity, as we would have said before. That's the balance between now the assets and the liabilities. We see the share capital is more or less the same. We see that their reserves have gone up. I think that looks like more than 50%. And we see translation reserve. Actually had to do research into this. I don't remember seeing it before. And what this means, or how it was explained to me, is that because the company might have another location, then they keep another location overseas. They keep some amount of capital for foreign exchange risk. Hopefully I explained that right. If one of the guys are here to cover that for me, just let me know. But this is typically to cover for the foreign exchange risk. Then we have retained earnings would have gone up, which is good to see. And we see non-current liabilities that are listed here as well. And as I said before, that's really based on the liabilities that would have been due within 12 months or less. All right. So I'm going to pause here for a little bit, see if there are any questions. Are there any questions? Let me know. Hopefully I'm not speaking over anyone's head. We're going to look at next the income statement. All right. So the income statement, or it's referred to as a profit and loss statement. It provides an overview of the revenues and expenses. So if you think about for just using again a personal example, your salary for you personally would be your revenue, and your expenses, your food, your utilities, your rent, those would be your expenses after you've paid. So everything that you do to generate that revenue or earn that salary, everything that you have to spend to earn the money would be considered a cost of sales or a cost of goods sold. That's one of the first things we're going to see. And then after you subtract that initial figure, we have what we call gross profit. And then we have some other expenses that we'll take from that gross profit, and ultimately that gives us our net. Right? So that's essentially a simple way to look at it. One thing to note here is that all that we're doing with these statements is categorizing income, categorizing expenses. So don't be intimidated by how they're named. If there's anything that you see that doesn't make sense, you can always research it. But what I've found is that the words are pretty straightforward. So when we look at the income statement, we'll see things like selling. What's the term I'm looking for here? Let me go to the next page. So we'll there's a term I'm looking for. I'm thinking of the abbreviation SGA. That's how I've memorized it. But we'll look at it soon. But the idea is after that, we'll also be able to see the net income, as I said before. We'll also see something very important, the earnings per share. You know, a lot of times we see this in reports, and we want to understand, you know, what it means, earnings per share. And then again, as I would have said before, it gives us multiple years to compare, because without that comparison, again, the numbers may not make sense. And the formula you need to remember here, same as I would have said before, your income is essentially your revenue minus your expenses, all right? So we're gonna break down the income statements now. So we have operating revenue, that's anything that is generated from the core business. So we're looking at Wisynco just now, anything that is generated in terms of revenue from their main line of business, that's what they consider operating revenue. Then you have non-operating revenue, which, as it implies, it's not generated from the core business. Then you may have other income. So those same investments that they would have had, for example, if that investment, you know, gets a profit, that may be registered as other income, right? Or it really depends, right? So as you see below, the non-operating income, that's our interest earned. If we have property, that's rental income. If we are receiving royalties from, you know, somebody using our brand or something that we would have created, that's royalty payments, and that is recorded as non-operating revenue. And if we sell any assets, so let's say that we have a building that, you know, is there for 20 years and want to move to a new location, and we've sold that asset, it's registered as other income. In terms of everything that's not, you know, related to revenue or income is an expense. And as I said, it's just categorization. It all boils down to the same thing. It costs the company something, so it's listed there. And there's a standard to which these things are recorded. There's not a lot of deviation. It really depends on the industry. There may be something that's relevant to their industry that it's worth noting, but typically the information you see on one balance sheet tends to be consistent between all the others, right? So we have cost of goods sold. As I said, the costs that are associated with us generating that core revenue is cost of goods sold. SGA that I was trying to remember is selling, general and administrative expenses, and that's just a really broad category to cover you know, all the costs related to generating that, as I said, that core revenue. So this may be like salaries. This may be if we pay, you know, persons to come and clean the office, if we have, you know, a maintenance cost, like all of those things could be rolled up into this. We have depreciation. So if we have let me think of something that depreciates. Let's say computers. So we have 100 computers. I think computers depreciate maybe 20% per year. So if we have $1 million worth of computers, each year we're registering 20%, which is 200,000 on the income statement as depreciation, so that we can account for that loss of value. It could mean, though, for example, when we're ready to sell those computers, you know, down the line, we may get, you know, half a million for it, then we'll register that as other income. And then that's how it would be accounted for. But, you know, these things are just, as I said, they are expenses that the companies have, and they're categorized based on what they refer to. And it is more or less standard for maybe 95% of all the balance sheets and income statements that you'll see. And just to kind of, you know, land the point further, typical expenses would be the wages, salaries, commissions, utilities. Let's say that we use a bearer service that could be a part of the SGA. If we have expenses that relate to, you know, maintaining a website, like anything that the company has to pay to keep its operations going would be listed under some expense category. All right. So if, for example, any losses that we may have, so let's say that let's say that same foreign exchange example, if there is a significant loss or something, depending on the type of loss, it may be recorded, and we will see at some point, I'm sure, a balance sheet that would have factored in a loss of some kind. I will see how it reports that. All right, so I'm going to go back to the same example that we had before. So let me just drop that, bring up the next screen, go there. So we're back to the Wisynco Q3 report. So we're looking at now the income statement, right? So we see at the top, statement of comprehensive income. We're seeing the period that it is for. We're seeing that the numbers are in thousands again. So all of this information, we're gonna add, 3 zeros. So it's in most cases millions or billions. So first line is revenue, and that's one of the things you want to watch. You want to look at that trend for companies. So if we weren't in COVID and we would have seen this decrease in revenue, we might have been overly concerned, but we are operating in COVID. And so you bear that in mind. And the truth is, I believe this is maybe, well, the analyst report will tell us the exact amount, but I believe this is 6%. I believe what it said, it's been doing, about 6% less each quarter since the year started, which all things considered aren't that bad. There were certain segments of the business that did better. And so it actually helped to maintain consistent revenues over the last 9 months. But, we can look at this number and compare it and say, well, we did better or worse than the period before. And then we have cost of sales, because we can't generate revenue without cost. So that cost of sales is there. We see that, it's more or less, it actually seems like the percentage would have been different, because they did 500 million less and their cost of sales was 500 million less. So that actually appears to be that they actually save some money in terms of what it would cost to generate the revenue. And we'll actually confirm that soon. We have the gross profit that's there. And, we go through and we see the different expenses as I would have mentioned before. After we take out these expenses, we have what's called our operating profit. We can just look at this total and saw that there was improvement there. That means that's a good sign. Finance income, well, I won't get too deep into these now, but if you think about what the term means, then you'll get an idea of what it relates to. And typically, as I said, if there's anything that is unclear, the notes will typically explain what that finance income or those finance costs entail. And if there's anything that's not explained, you can always ask the company directly. I believe you can email them and ask them about anything that is shown on their statements. Then we have our profit before tax. So all of these expenses that are taken out, our profit before tax would be this amount. And again, if we compare it to the period before, it is higher, which is a good sign. Then we have our taxes that we have to pay. And then we have here our net profit, all right? So then we look through the rest of it. If you just read it through, it'll explain things very clearly. So it says here under other comprehensive income, items that may be subsequently reclassified to the P&L. That's what it's accounting for here. And then items that may not be subsequently reclassified, that's what it's listed here. And again, for these things, depending on what it is, there's usually an explanation somewhere there. And then it says net profit attributable to the shareholders. That would be here. And then we see the same earnings or the same EPS that we mentioned. That's that number here. And that's a very important number. We'll get into that later. But typically you want to watch that number as well. You want to be sure the number is growing at least consistently. So, I mean, two periods is not really enough. I think persons like to analyze up to 5 years to see a real trend. I don't think two periods is enough to really see whether or not it's consistently growing. So typically you want to look, further back. So that would be our example for the income statement. Let me bring back up the slides here. All right. So hopefully everybody's with me so far. I'm not seeing many questions. Well, I'm not seeing any questions at all. So hopefully you're following. We'll have time for Q&A at the end, and I can explain further. But be sure that you're making notes. Be sure that you're really thinking about everything that we're going through. So the last statement that you want to look at for a company is a cash flow statement. And the reason why the cash flow statement came about is that the first two statements that we look at doesn't give a real example as to how the company would have used their cash, right? We've heard the phrase cash is king. And so a lot of persons actually like to look at the cash flow statement to see how the company is deploying the money that they have. And that is typically a sign to some that, management is good with money or bad with money. Management is making the right decisions as it relates to, taking on debt, or how they're, financing their operations, how they're using it. And so it's meant to complement the balance sheet and income statement. So you don't want to use any one statement by itself. So 3 key things that you'll see when we go back to the example. So we have operating activities. So if you think about on the income statement, it speaks about operating revenue. So sources and uses of cash from running the business. That's what we'd have in terms of operating activities and the cash that was used for these activities. You have investing activities. So how the company would have used this cash for investments into the long term. We want to see how well they're thinking about putting things in place to sustain the company's operation long term. Very, very important. And then financing activities. We want to see how they're taking on debt, how they're repaying any outstanding debt that may be there. Sometimes companies would refinance or issue new shares. Things to that effect would be listed here. All right, so let's look at an example again. All right, so we looked at the balance sheet already. Changes in equity. All right, so this is cash flows, right? So we see that it's for the same period. And we're looking at, so first, so remember the 3 broad categories: operating activities, investing activities, and financing activities. Those are the 3 main areas of the cash flow. So we have net profit from operations that would have been the same figure in the income statement. It's showing here items not affecting cash. And if you can imagine, there's no actual cash, but it didn't affect the cash position, but it's a part of. So remember we mentioned things that may impact that overall value of assets. For example, that you want to account for, like depreciation. So this is where it's shown. They might have written off some assets. So the assets would be still there, but they're written off because maybe it doesn't have what's considered reasonable value to be resold. So it could be written off there. Any gain or loss on the sale of property, plant, and equipment. So this would be 973,000. I mean, depending on the state of the company, this may be a negligible amount. Loss on sale of investment. So again, this is 85,000. I'm not sure, you want to be too concerned about that. Long-term investment plan expense, interest income. dividend income, interest expense, all of these things I think are very, very, very straightforward. And this now exchange differences. So Wisynco operates in multiple countries. So the difference in foreign exchange balances would have been, greater based on the period that was there before. And ultimately, though, at the end of all of that, we have a difference of about 300 million, right? So for a $3 billion company, well, no, the overall value of the company, we have, maybe about 1% change between the two. So again, that would be considered nothing to worry about there. Next, we'll look at investing activities. So they would have purchased more property, plant, and equipment. That money was spent. That's 424 million. They have purchased some intangible assets. They have purchased some investments. So they used 463 million to purchase investments. So what would happen when a company makes these investments? You see income from it. Maybe at some point in the future. So these are considered good uses of cash. Proceeds from deposits held over 90 days. That would be 1 billion. That's good. Proceeds from disposal of property. So they would have disposed of it, got 973,000 from it, dividends received, interest received. All right. And what you notice here, cash provided or used in investing activities, it actually moved from a negative figure to a positive one, to 609 million. So that's headed in the right direction there. And I mean, we're looking at these things, as I said, from a very, very, very high level, right? Because I'm assuming that persons are looking at this for the very first time. And so I'm trying to not overanalyze anything. So I want you to take everything that you see literally. So next, when we're looking at financing activities, it is what it says, financing activities. So we had to pay some interest. That's there. Proceeds from a long-term loan, long-term lease, long-term loans repaid. Those are reflecting cash outflows, but the more of our loans that we repay, the less it will be on the liability side on the balance sheet. So at some point we'll have to pay the money that we owe, and then we'll see that same amount being taken from the balance sheet in terms of our liabilities being reduced, which is a good thing. And everybody wants dividends to be paid. As I said, when the company pays dividends, it's cash that they have to spend. So they spend 712 million on dividends, right? And some companies pay dividends, others don't. I think it's good to have a healthy dividend policy. Dividends should not be at the expense of growth or investing in the operations. But if a company can consistently do it and reward its shareholders, I think that's an excellent thing. And we see the figure is same, so it's consistent with the year before. And then when all is said and done, this is our cash at the beginning of the period for all of the activities that would have taken place would have been 3 billion. So we ended the period with 6 billion in cash. And again, compare it with period before, it's a good sign. All right. So this is how you would kind of just at a very, very high level. I mean, there are some persons who can tell you, when, where the funds coming from, where it started, all of those things. I don't want you to get concerned about that right now. All you need to do is look at what the numbers are saying. You had 4 billion same period last year. Now you have 6.6 billion. Is that a good thing? Yes. All right. All right, so just a few more slides and then we'll go through a working example. All right, so the thing I wanted to bear in mind is that, financial statements aren't perfect. And also they're open to interpretation. And when I say they're not perfect, it's because it's historical data. So we would have been looking at March 31st. It means the realities for Wisynco now would have been different at June 24th, right? And also they're open to interpretation, meaning I look at the balance sheet, I may see it as a positive thing. Another person looks at it and says, well, it's not good because of this, or it's good because of that. So persons can draw different conclusions looking at the same information. And so just bear in mind, it is something that you use to make the decision. It's a part of the process, but understand there are limitations to using it. Sometimes there are creative ways that companies can report things that may not be as transparent as they should be. But that's why we look at both the quantitative and the qualitative. So we'll get to the qualitative in a subsequent meeting, but just to bear in mind that it's not a perfect process in terms of reading these numbers, understanding these numbers, but you want to become experienced enough and just know the language, know the terms used, know how they're used. Think of the broad categories, as I said. So, think about the balance sheet. You're thinking about three things: assets, liabilities, and equity. You think about income statement, you're thinking about income, revenue, expenses. Once you focus on those main categories, then you'll understand it more and you'll be able to pick up any balance sheet, any income statement for any company in the world and understand it at a very, very high level. All right, so we're going to do two things now. We're going to look at an equity report by NCB for Wisynco. And I'm going to show you that in comparison to the report that we just looked at. And we're going to see how NCB analyzes the same report that we just analyzed. And we'll see, what areas they would have focused on. All right. So I'm going to share my screen. Let me know if you can see it. All right. So for this, let me just give credit where credit is due. It is not my report. This is NCB's, report on Wisynco. It was published, I think, last week. And so I thought this would be an excellent example of showing you how you can interpret this report. So what I used to do when I was brand new to investing, I would take a copy of these reports, read through the report before I look at the statements, and then I would understand the statements even more based on the summary that was provided in the report. So that's an excellent way, I think. So let me just kind of go through at a high level this document first. Here it just shows a summary about the company and the disclaimer. And it speaks to a company overview. So we'll put some statistics. So this was done on June 16th. This was the price on that day. Let me zoom in a little bit more. No, let me go back out. Yeah, so this was the price on that day. The 52-week range, that would be for the last year. The highest price would have been $19.50, lowest price $13. Trailing EPS, so trailing would be for the last 12 months. Earnings per share would have been 72. Book value per share, that would be $3.97. Current trailing PE would be 21/4. So all of these numbers we'll actually dig into next week. So I'm not gonna really explain anything right now. The price target is $16.30. So from the current price as at this date, the calculations that NCB would have done in terms of their forecast for how Wisynco would end the year, they have a price target for 16.30, which is about, I think, 5% from where it's at. So they, based on their analysis, they're saying they recommend that you hold it. And by holding, it means that if you have it, don't sell it. And if you don't own it, it may not make sense to buy. Because, for example, if you should buy at 15.40, then with fees, you would not be able to make a profit if this is the price target in the coming months, right? So we'll get into this a little more, but that's essentially what you would interpret from this recommendation. So it speaks about the overview of the company here, and this is a great read to give you an understanding, but we look at this when we talk about the qualitative aspect. Speaks about the corporate strategy here. And where I want us to focus is the financial performance, right? So this is where we're gonna go now. So if we notice here, let me go back to the balance sheet. So it's talking about all right. So if you notice here, what it's saying that Wisynco did a 15.9 increase in net profit for the quarter ending March 31st, 672 million. Same number we're seeing here, and they're saying this is a 15.9 increase from the period before. The EPS is 18 cents, and we see that here. That's the same figure there. So already we're able to understand that this number makes sense based on this very same report. It's saying that this performance, this increase was driven by a reduction in costs. So Wisynco would have done something to increase or decrease their cost of goods sold. So it declined, as we saw, by about $500,000. And so because we spent less, we were able to see an increase in profits, right? Then it says selling and distribution expense would have contracted. And so bear in mind, right? So there are these terms that sometimes would be used, and they'll use different terms to essentially say the same thing. So it used the word reduction here, then it used declined, then it used contracted. I mean, all of this saying the same thing, right? So just bear that in mind. So it's saying that it decreased by 10.2% to 175, and we can just search for that figure, and we should see it. Well, it said it dropped by that amount. So if we look at this one, 1.713, 1537. If we deduct those numbers, would get that 175 million. And it's saying that, administrative costs fell by 4.7%. Again, we see a different word. It's the same thing it's talking about, same, numbers going down, but it's using different terms, right? So while finance expense would have decreased, and it's speaking to here, and if you read the document, let me just maximize this for a sec. It speaks to, the company's decision to decrease promotion and advertising efforts due to lower demand in the local market due to COVID, which we all know. So this is why the selling and distribution costs would have gone down. So there are two ways to interpret this. Because of lockdowns, it didn't make sense to invest the same in selling and distribution costs. Because we didn't invest the same in selling and distribution costs, we're able to save money. One one could argue that maybe they could have used the money in a creative way to maybe get more revenue. Another person could say it's a good thing that they saved that money, because if you weren't going to do, but so much within COVID, it's best to save that money, right? It says finance costs fell due to foreign currency gains. You see that word, that's a good thing. And then it says that those reductions offset the impact of a fall off of revenues, contraction in finance income, as well as a sharp increase in tax expense. And if we go back to the report, we can see the increase in tax expense, the contraction in finance income, and the fall off in revenues. And it says it here that revenues have been falling, about on average 6% per quarter, and we would have seen that as well, right? And then it's telling you why. So based on when COVID started, March 2020, you would have seen an impact on the revenue that they were able to generate each quarter because of this economic situation, this global pandemic that was there. This resulted in a 6% fall in revenue. And again, if you think about it, for what COVID has been, to only fall 6% is actually a very good sign. So it's saying this downward trend has been dated back to the first quarter of the 2021 financial year. And then it was saying it was first started with the styrofoam ban, which I think we all remember that. However, the downturn in revenues was compounded by the effects of the pandemic. All right, so all of this that we're looking at is what NCB is assessing based on what they know of the economy and what the report says. However, the downturn in revenues was compounded by the effects which led to suspension of tourism, closure of schools, restaurants, bars, entertainment activities, etc. So we know, for example, so we spoke about this at the start, with now those measures being relaxed, one could say, well, if the pandemic led to a 6% decrease in revenue, with now more places being opened up, more people being accommodated, then we could see a possible improvement for the next quarter. And it's saying, though, with all of that, despite this, we think I saw a surge in export activities. So remember that I was saying something must have accounted for why they only fell 6%. So it says that export expanded by 50% in Q3, which is great. And it's telling you that management is saying that this favorable outcome is due to the bigger brand in UK. And it's saying that the sales have been going well to date. So this information that we see here from about this paragraph down here is we're getting now information that is not shown in the report. So if we read this section combined with what the numbers say, it gives us an understanding of what the ecosystem or landscape of the company is like. And then it says now here, notably for the 9 months ended March 2021, the company reported a 1.9% expansion in net profits to 2.21 billion, and we can confirm that. It says net profits. So if we look for net profits here, where is net profits? All right. So March 2021, 2.21. Because as I said, this is in thousands. So this is 2.21 billion. Same number that we're seeing here. EPS of 59 cents. We see that there. So this same information. So if we looked at the report before NCB released this, we could draw the same conclusions. All right. And then it's just telling you some more information about it. And then it would state here their outlook. So NCB is saying that based on the report that they looked at, what they know of the the economy and what is expected, they would share their outlook. And I would definitely recommend you give this a read. We won't cover this week, though. We'll cover it next week. So, well, no, we'll cover it the week after this. All right. So hopefully you were able to follow that, right? So we're going to take some questions now. I don't know if anybody wants to ask me about any particular thing. Do we have any questions? I may just scroll through the chat. All right, so to get the NCB account, yes. So I see somebody responded, you would need to be an NCB customer. So what I try to do, there are some brokerage firms that gives you access to data by just signing up through their website. But for the most part, you have to be a customer. I like to get multiple brokerage reports and see what the experts are saying about the same companies I'm interested in. I weigh that information with my own assessment, and then I make a decision from that. And I'll go through in, I think, the fourth part of this series, how I kind of create my watch list from all of the information that I have. So I wanted to keep this concise. This is 30 minutes so far. I know it's typically shorter than our usual meetings, but I didn't want a really long meeting for persons to get intimidated by the length of it. So, are there any more questions? Let me have your questions. Okay. All right. So if there are no questions, I'll speak a bit about what we'll cover in part 2. And then I'll show you how I got all the information that I was able to share. I realized that I missed that step. So let me just share what I'll be covering in part 2. So in part 2, we're gonna, cover we're gonna do part 2 of the quantitative analysis. So we'll use the same reports and we'll apply the financial ratios to the reports to see to use as like a quick benchmark as to how well the company is doing based on those ratios. So ratios are like a good way to compare that company to industry standard. So how do Wisynco compare to other manufacturing companies? Are they doing well? Are they liquid? Are they, how are they managing capital, etc. Then we'll talk about stock valuation, which is extremely important. So we're going to look at, PE. We're going to look at EPS some more. We're going to look at, how those numbers are derived. We're going to look at book value as well. And then I'm going to share some resources, some tools that you can use to get that information. All right. So that's what we're going to talk about next week. So you definitely don't want to miss it. All right. So, Damian, your question about NCB reps providing those price targets, or is it a third party? Well, the analyst report I showed is from NCB. So that target price is what their research department would determine based on the model that we're going to show in later meetings about how. So there's a way to calculate what the anticipated value of the stock will be based on what you forecast the closing quarter to be. So whenever you see a target price being referenced, and you'll see as well, multiple companies have multiple target prices because they may factor in multiple things to bring about that target price. And you'll see it a lot for IPOs as well, for example. So you may see an IPO come out, I remember for Trans Jamaica, for example, the ranges went from about maybe $1.50 to about $1.73 in terms of target price. All right. So next question is, how do I deal with too much information or information overload? Well, I narrow it down. So I don't track companies that I'm not holding. So I'm using Wisynco here because it's a company that I'm personally holding. So it makes sense for me to invest the time to use it as an example because it's a company I have in my portfolio. Now, I'm not telling you to buy Wisynco. This is not financial advice, but I filter my time based on the companies that I'm interested in. So I have a vested interest in Wisynco. So I spent the time preparing for this presentation by looking at the same report that I would have looked at anyway. So like any company that you see me sharing or talking about personally, I would have been interested in some point or owned it at some point or still a shareholder. And that for me is the way that I deal with just information overload. So I can't track all the companies. I can't do that. How do I deal with how can you use this information to know when to divest? Well, so using that same report, let's say that so based on when this report came out, we have information since saying that, things are going to open up, which means, a good sign for companies. The next quarter seems like it could possibly be better than the current one. So even that same forecast from NCB, it could potentially be higher based on the fact that things are being a little bit more relaxed. Maybe we see some more parties, popping up, or, entertainment activities, cinemas are opening up again. So the main thing to look at is you want to know the things that impact revenues for the companies that you're holding. So think about how Wisynco makes money. What goes into the bulk of their revenue? So whatever, companies are in your portfolio, what are the drivers for their success? So let's even look at Mailpack, for example, who I just got a dividend check for, by the way. I'm very happy with the amount on the check, by the way. Mailpack's line of business is impacted positively by the pandemic. So, because more persons are home, more persons are using shipping services, more persons are using PriceSmart to deliver their goods. That's a positive thing for Mailpack. So based on the climate that is there, it favors that company. So it would be a company to look at, to do a proper analysis on, to see whether or not it's worth investing in. Now, the timeline as to when you should maybe switch from that company, it depends on your personal goals. It depends on how long you see this company being of value within your portfolio. My personal thing is I would typically have a price target. One, I would typically have a target as to when I think a company has grown to a certain point that maybe I'm not going to see the same type of growth that I would see for the period that I've been holding it for, right? So hopefully that helps. In terms of top companies, Akeem, you're talking top, and let me put the questions on the screen so persons can see. When you say top 15 companies, what measure? You could do top companies by revenue, you could do top companies by market cap, you could do top companies based on, customer base. You have to choose the measure that you want to consider, what would make them a top company. All right, thank you for that feedback. How do you use financial statements to narrow or decide between two companies? That's an excellent question, right? So first of all, it wouldn't make sense, at least not to me, to compare two companies in terms of their balance sheets from separate industries. So typically you do the comparison within the industry. Right, so to compare, for example, our Wisynco with Mailpack, to me, I would take that as an opportunity to diversify. So if you like both, buy both. But if you're trying to choose one to buy, so should I buy Wisynco or should I buy Mailpack? If you want to only decide on one, then you want to look at which company provides you with what you're looking for. Are you looking for, consistent dividends? Well, for the last few months, Mailpack has paid, reasonable dividends. Wisynco has paid their dividends as well. So that's one checkbox. You may want to say, what's the growth potential? What's the ceiling for the company? Well, Wisynco is a global company. They're seeing growth in multiple areas. They're consistently cutting their costs. That's one plus for them. Mailpack is also seen as there are potential opportunities to expand even outside of Jamaica. Who knows? So you want to kind of go through. You want to analyze the businesses to see which one fits into the type of investment you want to make, right? But to say, which one is better, it really depends, right? Because one could be better in the short term, one could be better in the long term. So that's how I would say it. So sector matters from the perspective that some sectors are seen as more profitable in terms of whether the dividends they pay or the growth rate of that sector. And we'll cover that in the third session. Top long-term performing companies. Well, that sounds to me like you're talking about your staples. So you're thinking about those companies that have probably been around since you were born and are still here because they're consistently doing well. And if you want to know those companies, just look around your house is what I'd say. What is the best measure indicator to use, whether or not? So what we're doing for the next 4 meetings, this one included, is we're going through all the things that you want to consider in determining which stock to buy. So you start with the financial statements. Next, you're going to apply, ratios to the financial statements. Next, you look at the qualitative aspect of the company. And then you want to from that forecast now the future earnings of that company that you'd have done the analysis on. And from that estimated value, you can determine what you consider to be what we call a margin of safety for that company. If the margin of safety is favorable, then you can, select that company for investment. That's the process that we're going to go through over the next 3 to 4 weeks. Why do you think equities like L.E.A.R.N are not performing? That we'll speak about in the qualitative aspect, right? So let's take QAI, for example. They publish what's called a net asset value. So I think QAI trades at about 95 cents right now. The net asset value, I believe, is 120. Somebody can probably, correct me if I'm wrong. It's not trading at that because it's the investors that determines the day-to-day price. So a company can be valued one thing and not trading at that price because the investors who are buying and selling aren't selling it and buying it for the price that it's valued. So we'll talk about that in a qualitative meeting. We'll talk about things like, things aren't always sold for what they're worth. And that sometimes that's your decision to either wait until it gets to that value or to choose another opportunity. That's your call. What platforms I use to view charts? So it depends. So I actually promised you that I would show you. Let me show you something here. All right, so I'm looking at the Jamaica Stock Exchange site, and Mods, I'll ask you to put the link in the chat for this page. So this page, if you go to the JSE's website, they have listed here all of the companies that trade on the stock exchange. So from here, I can see, the 3-month chart, 6-month chart, year-to-date chart for this company. And I can see from this, maybe the price movement. So it says in the last 12 months, the highest price was, I think, around $19. We're seeing that here. It has the candlestick chart as well, and we'll cover this in our session on technical analysis. So we'll get to that at some point. And I can see here, the range that the price that it traded at today, the range for today, the 52-week range, and the volume. And we'll talk about why volume is important when we talk about technical analysis. We can see the shares outstanding, and just to change, quarter to date, year to date, etc. All right. So this is one source. This is probably any other source would probably be pulling from this. So I use this site a lot, and there are persons who would create their own Excel sheets, get their data from the reports and track it that way. That's also one option. There are platforms that we're looking at, but because we have not had any official partnerships yet, we won't mention them here. But there are apps and tools and sites that you can use that will give you essentially maybe a better presented information than what you see here. But again, it pulls from here. So if you learn how to use here, you're okay. So if I wanted to see the latest news for them, so I saw today, well, not today, I saw it today, but it wasn't today, that they're considering a dividend. And I'll speak about this in the qualitative section, where you'll always see an announcement of dividend to come. So it says June 28th, and then on that day or the day after, you'll see that it was published whether or not they made a decision to give a dividend, and then dividend would be paid at a later date. All right, so I'll explain what all of these things mean, how you interpret them or factor them into your decisions to invest. All right, let me see if there are any other questions. We're going to wrap up soon. So if you have your questions, ask them now. All right, any question that I would have missed, please let me know, but I'm not seeing any more. So yeah, so that's the one. It says, how do I see GK at $100? What's next? What do you mean, what's next? I don't understand that question. So I saw somebody tweet out that, they think GK is worth a lot more than it's currently traded at. I have no comment on that. I think Akeem would have asked a question about, top or stable companies. I think a lot of persons would argue that GK is one of them. I think GK has shown that they are able to do well even in a pandemic. So it's a really good company. There are a lot of persons who like it. I'm personally not a holder of GK, so I can't speak to it. I don't hold it. Do I like the company? Yes. The blocker that I have to GK is a really ridiculous one, but I don't know if it's worth mentioning here. Why do I think GHL is on a free fall? I haven't looked at it, but it's just because. So I said this a few moments ago. Just because something is valued, something doesn't mean persons are willing to pay what it's valued. And if you think a stock is valued more, then that's an opportunity for you to buy. So if it is that I own something and I need capital to buy something else, I may decide to sell something at a cheaper price. So I think one of the things that persons forget is we don't always know the cost that a person has what they're selling. So for example, I may own something for $10. I may have bought GK at $10, for example, and I'm selling GK now at $90 or $85. You may say, well, GK is trading at 100, but you're selling it for 90. Why? Well, I bought it at 10. So my profit is 800% and I'm selling it, it's good for me. All you see is a trade that says a person is selling something for a price. We don't know the motivation. We don't know what inspired it. We don't know if they see a great opportunity. But what we do know is that for every seller, there has to be a buyer. So I can't sell that stock for 700 or 650 if there's nobody willing to buy it. And the opposite is true as well. All right, sorry about that. What are some good stocks for a new investor, Samantha? The sessions that we're having now hopefully will help you pick your own stocks. But what I would say as a new investor, you want to invest in companies you understand. Invest in companies that you can clearly identify the business model, clearly identify how they make their money, clearly identify what risks are there that will prevent them from making money, and use that to determine whether or not they're worth investing in. Over the next 3 weeks, we will explain the things you need to do to determine which stocks that you should look at. And I will show you how I create my own watch list. Hopefully that will help. But in terms of which stocks you should look at, it, I mean, it's there are so many options, right? So, but the guidance would be to invest in companies you understand. I know that we live in a world where a lot of persons may, tweet the companies they're interested in. I personally don't do that because I always say that if you don't know why I buy it, then you won't know why or when I'll sell it. So I may tell you to buy a stock right now, but you're not around when I'm ready to sell it, and then you might make a loss, and then you're blaming me for telling you which stock to buy. All right. Okay, you're asking about a split for GK. I don't know. I really don't know. I can't say. I've heard persons say that a split makes sense. I've heard persons say that they wouldn't be incentivized to split. Time will tell. And I mean, our market seems to respond very well to splits. So if it is a split, for some reason, persons see a lower price stock and think that it is somehow cheaper. A split doesn't mean the stock is cheaper. It's essentially, it has now maybe made it a little bit more accessible, but it has essentially diluted the value of what you had before. So where you had one share for $100, you now have 10 for $10. There's more of those shares in circulation. So supply and demand may say that what you had before is now valued less. I mean, yeah. Jamaicans just not used to trade. So I would yes and no. I'm mindful to look at these things. So remember that I think we have maybe 5,000 to 10,000 registered investors, or there's number 15,000. Maybe somebody can help me with that one. I don't make such generalizations because, for example, I know I'm not interested in GHL right now. It doesn't mean it's not a good company. So if you think about the price of it, it may limit certain investors. So let's say that you wanted to own 100 shares. You would need, I think, 75,000 based on the price that it was at. Maybe some person's investing with $10,000. So if I only have $10,000 to invest, I may not buy a company like GHL because in my mind, I'm only able to own a certain amount of it. Now, some persons may say it doesn't matter how much you own, it's the profit. I am actually inclined to disagree. I like to own more of something that is good instead of less. So I see Chike saying it's an excellent company. I haven't looked at it. I'm sure it is, but if I could only own 10 shares of it versus another excellent company or a good company that it's selling for less, I would take the less company that is equally good, maybe not the same, maybe not the same industry or anything like that, but I like to hold a certain amount of units so that I have the flexibility to take profit while still holding my position, while still holding a certain amount of units. So because of that, if I can't get a certain target allocation for that stock, I'm less inclined to buy it. But it doesn't mean that it's not good. So I mean, my question to Chike is, it's an excellent company. Do you hold it? Don't answer the question, right? But that's kind of how I see it, right? So think about it. But I've heard good things about it. We've talked about it in the group, and I think that you can't own every good company. You can't own them all. Make good decisions, choose well, and some things may just have to miss you, and that's okay. If you hold 5 companies and they go 1,000% each, you may miss some that go 2,000%, but you made 1,000%. Be happy with that, No, so Damien, I'll just ask you this question: would you spend $60,000 on one Bitcoin? That would be worth 30,000 right now. I would just think about that. And I'm not saying Bitcoin is not good, by the way. It's not for me to say. But yeah, maybe it's the same analogy. Who knows? Yes, Chika, exactly. Do your homework and don't get greedy, right? I'll take the final question and then I will end the meeting here. What is my idea of a good number of units to own? All right, so I'm going to cover this in depth in the last session. But personally, and again, this is not financial advice, personally, I like to own what I consider a large volume of units, right? So if I'm investing in a company, I like to own a certain number of units. So let's say, depending on the price, I may go for 10,000 units. If I have 10,000 units, the train of thought that I have is that if I have 10,000 units, when I get to my first profit target, I can sell 2,500 units. When I get to my next target, I sell 2,500. Then I can hold 5,000 for the long term if I like the company that much. If it's at a price where I can hold 50,000 units or 100,000 units, that's what I'll do, because in my mind, I'm saying, well, if I have 100,000 units of that stock, for every dollar that I gain, I'm gaining $100,000. And that's kind of how I look at it now. I've come a long way in learning that price is not the same as value. So there are a lot of stocks that I hold large volume of units for that aren't doing as well as the companies that are priced a little bit more. So I've learned to not let price determine what stocks I buy. And it has taught me the value of knowing when to sell as well, right? So, but that is the idea of, to me, a good number of units, right? So if I have enough to take profit and still have a comfortable position, I lean for it. So if I can't get 10,000 units of GHL, 10,000 units is how much? $7 million? Is that right? Is that right? Yeah. So it's just not for me, but it does not mean it's not a good company, right? Well, I mean, I actually, Merrick, I don't know how I feel about Select F for me, and we covered this in a previous meeting. For me, I would look at how Select F is weighted and buy the companies that they have bought. Because for me, personally, I don't see the value in Select F. Now, Chike loves Select F. Chike thinks that, it's a good long-term company. And for honestly, the price that it's selling now, it may be worth looking at. But personally, I'm not a Select F fan. So, I mean, did they add did they add GHL to their position? That Select F, did they do that? Yes, Drea, knowing when to sell is very, very important, right? So, but that's my idea. So I invest in volume, and that's why I don't invest in as many companies. I have 15 stocks in my portfolio now, and I'm looking to consolidate that down to 10. And what that means is that when I add to my position every month, every quarter, I can hold a certain amount. And to me, that's a little bit more attractive than owning 30, 40 companies. It just doesn't make sense for me. And I don't want to be tracking 30 companies. Now, I've seen what persons may do is say, well, they'll hold a small position. So they own 40 companies, but they're weighted in 5 or 10. And then they may buy, let's say 1,000 units of GHL, 1,000 units of Palace, 1,000 units of NCB, 1,000 units of GK. And then they'll hold that maybe 5, 10, 15 years. Maybe over that time, it becomes larger in value. And so that you still gain from having it. I don't take that approach. That's not personally my style. All right. Okay. Hopefully I would have answered all the questions, guys. Thank you so very much for being here. Hopefully this session was good. I will actually be removing this Q&A section for the last 30 minutes from the video, so that when persons click on it, they can see just the topic that was covered. And I'll try to just release this Q&A part as a separate video. All right, so that's what I'm going to do. So if you come back to watch it and you don't see this part, that's why. For next week, we're going to go through financial ratios, how to use them, what ratios are worth looking into, and things like that. All right, so really hope you enjoyed the session. If you did, please leave the video a like. Please share the video with a friend. If you're not subscribed, please subscribe. It really means a lot to us if you do that. And I'm looking forward to next week, and I hope you are too. Until then, take care of yourself.